Good evening, everyone, and as always, thank you for joining us today. If there's any issue with the audio, please raise your hand or put in the chat box. I'm assuming I'm audible and clear. So, the RBI policy, if anything, today could be characterized as being slightly more dovish than what the market consensus expectation was. So, they did not hike repo rate, which was pretty much as per consensus. There was a small outlier risk that they would change stance to withdrawal of accommodation in preparation of future rate hikes, and they did not do that. So that was clearly dovish. But more so, if you see their general characterization of the growth inflation trade off, this seems to be actually a more dovish policy than the June policy. So, in summary, the takeaway from the June policy was that the RBI assessed there was risk of pass through of higher food and fuel prices into generalized inflation. They were not seeing that yet, and therefore they were waiting and watching. So that an August policy hike was pretty much out of the question. But future policy rate hikes were pretty much on the table if inflation became generalized. The characterization in today's policy seems to be that despite rising food and fuel prices, and despite headline inflation actually going up to 5.9% in their assessment by Q3 of FY27, they are not seeing any sign of generalized inflation yet, which is to say that the higher food and fuel prices are not passing through into core prices at all. So they remain very comfortable with the trajectory of core inflation. In fact, one of the notable changes to their forecast from the June policy was that in the June policy, they had assessed, or the RBI had assessed that core inflation will be 4.7% for this financial year. That they have brought down to 4.3%. So a lot of the assessment seems to be guided by this observation that core inflation is actually turning out to be lower than what we thought. And we are not seeing signs of generalized inflation at all. So, the usual characterization that we are watchful and inflation is going to rise from extraordinarily low level before remains. But if I were to summarize what they're effectively saying, it is very much, what we have been thinking as well of how we are reading them, that, they may hike modestly at some point in the future, but it's not yet assured that they are actually going to hike. So our own reading is that we would expect a maximum of 50 basis points of repo rate hikes and not before the October policy. At this juncture, even October policy does not look like there is more than or even a 50-50 chance for October. So put it another way, as of now, it looks like that 50 basis point cycle may actually start, if at all, after October. Just like the MPC, we are also not confident that those hikes will at all come. However, if headline inflation pressures continue and if they were to start to filter a bit into core inflation pressures, then, those 50 basis point hikes may very well be coming down the line. So, the dovishness of today's policy basically sprung from that fact that in the observation of the MPC, there is no sign of generalization of CPI inflation, even though food and fuel prices are rising, and the average CPI forecast for this financial year is actually 5%, which is 10 basis lower than what they earlier thought. But like I said before, the big takeaway was their scale down of core inflation by 40 basis points. On growth, they are reasonably, confident as of now, in the sense that recent growth outturns have been strong enough. So credit growth is strong. A lot of concurrent indicators of the economy have been strong. Services sector growth rate has been good. However, they are, concerned about, some of the fog that exists in the system, both from possible inadequate monsoon pressurizing farm incomes and therefore rural demand, as well as the pressures from, the trade wars that are undergoing, as well as the West Asia war pressuring company margins, etc., and therefore impacting aggregate demand. So the characterization on growth would be that it's strong, but it cannot be taken for granted in some sense. Curiously, strong growth is not filtering into core inflation. So the MPC is simultaneously saying that India is the fastest growing economy in the world and growth is reasonably strong. However, it looks like it's not strong enough that it's filtering into core inflation. So, like I said, the net assessment remains maximum of 50 basis point rate hike, if at all, and the timing of that remains as yet unclear. Now, let me turn to more practical issues that are relevant for the bond market. So, as most of you who have been hearing us or tracking us know that over the last almost most of this year or since late last year, our worry has been that RBI monetary policy has almost become irrelevant to the bond market. So we have seen RBI cut rates significantly by 125 basis points in all. Till very recently, prior to the West Asia war breaking out, they were even guiding for lower for longer on interest rates. Last year, the RBI bought government bonds totaling to 10 or 11 lakh crores. And yet, you have not seen bond yields really respond to all these measures. Bond yields, in fact, have been quite volatile. And even prior to the West Asia war breaking out, that volatility remained. And they were not necessarily following all these strong actions that RBI was taking. So our assessment of this has been that India has been suffering what is known in financial markets and macroeconomics as the impossible trinity phenomenon, which in an emerging market context means that if your balance of payment is under pressure, that filters into currency pressure, and that in turn impedes the transmission of monetary policy, or put another way, monetary policy therefore is unable to independently act on local growth inflation concerns. So while RBI has been setting repo rate and trying to set financial conditions basis the local growth inflation trade-off, however, financial conditions actually have been tightening because of the impossible trinity phenomenon. Put simply, because we have not been getting adequate capital flow for the last few quarters. And despite running a relatively small current account deficit, our balance of payment has been negative for 2 successive years, FY25 and FY26. Now, this is basically the lens through which one has to take a fixed income view. So first of all, to recap, why are we suffering weak capital flows, or why have we been suffering weak capital flows? Largely because of three reasons. One is high global interest rates. Second is competing capital themes, more specifically the AI financial stock theme as well as the AI capex theme. And third, more recently, the West Asia war. Now, if you see, each of these three factors, to some extent, there is positive news from our standpoint. So we are seeing over the last few weeks some shakiness in the AI theme, in the sense that a lot of hyperscaler as well as the supply chain manufacturers related to the AI ecosystem have suffered some volatility in their stock prices, and there has been some two-way shakeout as far as capital flow into these stocks is concerned. Second, there seems to be a little bit of investor concern now with respect to the kind of capex that the so-called hyperscalers are undertaking, so that there is a chance that if those concerns continue, then these companies are forced to spread their capex program over a longer period of time. And if these two things were to happen, which is continued shakiness with respect to financial stocks, with respect to the AI ecosystem, and potentially some easing off of private sector capex related to AI, then this would probably lead to a weaker dollar and lower global yields, which will be beneficial for India capital flows and India interest rates as well. So because these are two of the three reasons which have contributed to the weak capital flows into the country, therefore, we are watching closely if these reasons start to unwind or at least stagnate, so that some of the issues related to our capital account actually start to sort themselves out. The third is the West Asia war, and as you know, the developments over the last couple of days seem positive. So let's hope that those follow through and commodity prices fall again, so that pressure also eases. As you also know, in the June policy, the RBI and then subsequently the government have undertaken capital flow measures, largely the FCNR scheme, the discounted hedge window for ECBs, as well as Government of India abolishing all capital gains and coupon withholding tax on government bonds for FPI investors. All told, these measures, especially the FCNR measures, have so far yielded rich results, with the expectation now being that the total inflow under the FCNR and ECB scheme can easily cross 80 to 90 billion dollars, and that gives a good short-term buffer for India currency and India capital account. Now, the way we are analyzing this development is as follows. So there's no doubt that in the short term, this buffers the currency. This allows breathing room to us. However, we will also look for more sustainable capital flow measures coming from government and RBI over a period of time. So we are already seeing certain other relaxations being put in place, certain ease of business initiatives being undertaken. So, what the FCNR scheme does is it is effectively borrowed capital for the next 3 and 5 years. And it basically therefore is just purchasing a window of time for you. It is not sustainably solving for your balance of payment issue. So remember, what all you are getting now, you have to return in 3 and 5 years time, mostly the 3-year window time. And therefore, for the relief that it has provided so far, we have to use that window judiciously to also seek permanent capital flows into the country. However, there is a very strong signaling effect attached with what has been done also, and we are hopeful that further measures will also be forthcoming. The other important impact that the FCNR does is it solves for the credit to deposit ratio of the banking system, at least for this quarter and part of the next quarter. So as you know, these FCNR deposits come and sit on bank liability side, bank deposits. And therefore, the issuance pressure that banks have had for bulk deposits as well as bank CD, that comes off. And we are already seeing, rally in money market rates, etc., because of this development. Our sense is because, the number for FCNR flow has now been scaled up, and because RBI doesn't seem to be in any hurry to hike rates, money market rates, although they have fallen, still look reasonably valued to us. So, this is as far as the FCNR scheme is concerned, and the two impacts, namely, it purchases us a window of breathing room, but more permanent capital flow measures have to be undertaken. Good signaling effect. Also, it solves for bank CD ratio problem, at least for this quarter and part of next quarter. Simultaneously, if you were to continue to see the unwind of the AI trade, including some stagnation in AI capex, then that would be very bullish for India assets, because the FCNR window would have purchased you time. And if some pressure on dollar and global interest rates were to simultaneously come off alongside some cessation of the West Asia war, then you could potentially get a confluence of very benign events for India. And that would be great for India bonds for that period. So, that's another way to, think about what's happening there. However, the essential point here is that some of the global factors have to start to unwind, largely the AI and AI capex pressure that is being put on both capital flows as well as interest rates, for us to sustainably breathe. And also that, some further meaningful capital flow measures have to be coming from government and RBI to shore up what has already been done. In terms of market views, so, one characteristic of India fixed income market or India market rates has been that they have almost completely delinked from RBI repo rate, barring the very front end of the yield curve. So you are seeing, your 3-year, 5-year corporate bonds somewhere in the vicinity of 715 to 740, depending upon which issuer you are talking about. You are seeing 1-year bank CDs still in the vicinity of 710 to 725, 730. You are seeing, your 15-year government bonds at close to 7%. You are seeing 30-year government bonds close to 745, 746. And you are seeing, 40-year government bonds at 755. So, a lot of market rates are in the sevens. And it's very curious, your RBI repo rate is actually at 5/4. So what continues to be the case for India fixed income is that as long as you can take a reasonable view that RBI is going to be modest in their rate hikes, and that's a reasonable view you can take, especially after today's policy, you don't need to fear the RBI rate hike cycle in order to make a decision to allocate to India fixed income. Rather, the unlocking of value that remains on the bond curve will be more a function of what incremental capital flow measures are taken, and whether, like I keep referring to, some of the pressure points in the world, move in our favor. So some unwind of the AI trade, some capital flow back therefore into India, cessation of war, and therefore easing of capital flow pressures or balance of payment pressures triggered by the war as well. The other point is, what is the state of growth in the economy? So as you know, credit growth has been doing very well. It's growing at around 18%. A lot of concurrent indicators in the system have moved up. YTD direct tax growth has been very strong, especially corporate tax growth has been quite strong. Indirect taxes is where we have lagged a bit. However, it is possible that both for RBI and for analysts, one is not getting a very clean read on the underlying momentum in the system, because remember, there was a very large tightening of financial conditions in India somewhere around mid to late 2024. And then early 2025 onwards, RBI took a variety of steps, both to infuse liquidity, do bond purchases, as well as some macroprudential easing, which eased system financial conditions significantly and allowed for a massive bounce back of credit. So the question, that a lot of us are now looking to answer is, how much of this very large bounce is a normalization of the weakness that you saw in, let's say, half or more of 2024? And how much of that is genuine acceleration of the economy? I mean, the truth is somewhere in between. Probably it's to do with a bit of both. The other complication for the time being is because of the war, the working capital requirements in the system have moved up. So a bit of bank credit acceleration is also happening because working capital requirements have moved up. So RBI's theme here, as far as growth is concerned, also seems to be this, that they are cautiously optimistic. They are happy about the concurrent indicators that are rising. At the same time, probably they also don't have as clean a read as they would like it to be, and there are clouds on the horizon, including from trade, from El Nino, as well as from the West Asia war. So in summary, a dovish policy highlighted by the fact that RBI scaled down their core CPI forecast from 470 to 430. Commentary is in line with that. They don't really see demand side pressures. Although some rate normalization could be expected, the timing of that is not clear, and we certainly don't expect more than 50 basis points of hikes. Meanwhile, the FCNR and other schemes have bought us some window of time to take more permanent measures for capital flows. From our standpoint, the hope would be that there is some stagnation of the AI trade. There is some stagnation of the private sector capex cycle that you're experiencing in the developed market system. That in turn releases some pressure from the US dollar as well as US interest rates. So that can further accelerate the momentum that India is currently seeing. As far as bonds are concerned, a lot of the bond market is very attractively priced. What we like is up to 3-year, 4-year AAA corporate bonds and 15 to 40-year of government bond curve. We think both these are actually very well placed, very attractively valued, and you will see a lot of our portfolios running a combination of these. So up to 3-year, 4-year AAA, as well as the long end of the government bond curve. As far as money market rates are concerned, they have fallen, but given that you are going to see the bulk of the accretion to deposits over the September quarter and partly in the December quarter, as well as system liquidity for the time being is going to be quite abundant, and one is not really fearing too many rate hikes. These levels still look okay from a valuation standpoint for relevant time horizons for money market as well. Just one last point before I close and invite your questions. RBI also made an assessment, a loose qualitative assessment on liquidity. So remember that if $80-90 billion comes, our own assessment was that what we call core system liquidity may actually peak at somewhere around 9 to 10 lakh crores in the system. RBI governor also mentioned that by September liquidity peaks, and after that there'll be drawdown of liquidity as well because of currency in circulation pressures. Because RBI also has a forward short dollar book, part of it they may unwind. So one that did not get a sense today that RBI will actively take liquidity neutralization measures, and they will basically allow for a large part of this excess liquidity to drain out by itself because of these factors. So that was actually one other relief for the market today, because there was an outlier fear that RBI may undertake OMO sales or things like those to absorb excess liquidity. but did not look like from the governor's statement that anything of that is basically being considered. So, that's pretty much our summary of what went down today.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.